Hello and welcome to another episode of the Business of Business podcast. I'm your host, Roy. Of course, we are the podcast that brings you a wide variety of guests that speak to a lot of diverse topics. Today is no different. We're excited and been waiting quite a couple months here to get Hall T. Martin on the show, and I do appreciate Hall's patience in this. But Hall is the founder and CEO of 10 Capital and host of the Investor Connect podcast. He launched the firm as the Texas Entrepreneur Networks in 2009. Today, 10 Capital has over 12,000 investors in its network and has helped startups raise over $900 million. Mr. Martin serves as the vice chairman of the Baylor Angel Network, and he previously led the Central Texas Angel Network, the CTAN, as its first executive director. Mr. Martin is also host of the Investor Connect podcast. He is the founder and director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of startup investors. He is also the founder and managing director of SKU Incubation Station, a consumer product goods accelerator based in Austin, Texas, and the former managing director of Accelerate NFC, an accelerator based in Dallas, Texas, focused on near field communication. Mr. Martin also serves as an adjunct professor at the University of Texas, leading the Idea to IP program, which fosters startups from the engineering program. Hall, thanks so much for taking time out of your day to be with us. Certainly do appreciate it.
Great, Roy. Thanks for having me here. Looking forward to our discussion.
You bet. So what has led you, I guess, what is your background and kind of how did you find yourself in this position? What led you to, I guess, be an investor and want to help others grow their businesses through the accelerators and everything else?
Sure. Well, I've always been an early stage startup guy, and I went to work for a company in Austin back in 1986, and then they went IPO in 1995, and I started doing angel investing after that. Had a lot of fun with it, made an investment in an Austin company, and probably lost all my money and discovered it's harder than it looks, but still like the early stage. And then we had an angel network in Austin called the Capital Network that ran from 95 to 2002. And then they were tied to the .com world. And when that went away, they went away with it. And so we didn't have a group. 2006, the city did a restart and they called it the Central Texas Angel Network. And I said, I want to be a part of that. So I was the first member to sign up. And when you're the first member to join, you're automatically on the board in charge of membership. And it's a great honor. No pay, but it's a great honor. So we did that. And after a couple of months, we lost our director. So I became the director and I led it for the first 2 years. We got about, 50 members recruited, 5 million invested in 20 deals. And we got we ended up getting a 40x return out of 2 deals. So it turned out to be a great win and propelled it forward. Then my undergrad, Baylor University in Waco, wanted an angel network. So I helped them set it up and I'm still a member there. And then Williamson County wanted an angel network. So I just had a lot of fun putting these angel networks together. And so in 2009, I started the Texas Entrepreneurs Network to help startups connect with investors because I saw the challenge they had in getting introductions and doing the process. And then over the years, just kept growing the network of investors from just within Texas to across the country, not only angels, but now venture capital and family offices, and started doing our program on a national scale in 2017 when we changed the name to 10 Capital, and been going ever since. I just like early stage companies, and I like working with investors and startups.
Yeah, I mean, that's an exciting place to be. I mean, I'm sure that even if you don't invest in them, I'm sure you get to see a lot of great products and services that come across your desk in the very early stages.
Absolutely. See all the new technologies, see the new businesses coming up, and it's great to see companies grow and mature over time and help them as well. Love to mentor and network with startups and founders to help them succeed.
So funding companies, and we don't want to take a whole lot of time, but I think for some of us novices, maybe you could just explain some of the difference. You could just go to the bank and get a loan, usually backed by the SBA, but then we have angel investing, venture capitalists, and then crowdfunding has become a much bigger player, I'm assuming. But can you just kind of give us a little brief description of all of those different vehicles of investment?
Sure. So when you get an SBA loan, you're primarily taking on debt, and you have to pay it back. And once you pay it back, you're done. And then there's some businesses that are higher value, maybe higher growth rates, more scalable, and they can be sold for a nice amount of money. So those go into the venture world, which are led by angel investors, people investing their own money, or venture capital, which are people that are running funds where they're investing other people's money into it. And they're taking equity. They're not taking debt. They're putting money in because we're trying to make this business as big as possible, to sell it 5 to 7 years as a target, to make a good payout for the founders as well as all of the investors as well. And so we've been working under those models for many years. And the angel groups I started were in that dinner club model in 2006, 7, and 8, where 40, 50 investors come together. They look at a deal, they decide to invest in it, and then they're on the equity side of it. And then along comes crowdfunding. Or early on, crowdfunding was the Kickstarter, Indiegogos, where it was just rewards and prepayment. You weren't really getting a stake. You were just prepaying for the product, which is a form of crowdfunding. And then now we have what's called Reg CF or Title III crowdfunding, where you're actually getting an equity stake and anybody can invest, not just accredited investors like the angels and the VCs were, but anybody can put money in. Average investment today is around $500 per investor. Wow. And at that rate, you can get quite a few people. It's all online. The crowdfunding world has been doubling year over year for the last 3 years. Keeps going up because everything's going online, not just standard technologies and so forth, but also fundraising is going online. Email and websites are now the first place people go, and so it was well positioned, especially during the COVID times, to accept funds and so forth, because everybody wants to be a part of the startup world. Post-COVID, it's an ideal time to start up a new business. We have a whole new set of careabouts. We're starting a whole new startup cycle. Interest rates are zero. Stock market's all-time high. A lot of money looking for a place to go. So it's a great time to start a business and raise funding from either angels and VCs or the crowdfunders.
Yeah, and again, I know that this isn't really your wheelhouse, but on the crowdfunding, how did, like a VC or angel, usually they come in and take a piece of that business. And so, there's some negotiation, I guess, with how much control, how much percentages that they may take. But like the crowdfunding issue, is how does that work? Is there somebody that's kind of in charge of what is raised for that certain piece, or how does that work exactly?
Well, the way it works now with the Title III crowdfunding is you go to a portal. It's basically a broker-dealer license portal. There's about 50 licenses out there, but I'd say 95% of all activity goes through 3 to 5 portals. So it's pretty well concentrated. Okay. And you set up on their portal and you put your investor documents together. You go through the compliance issues. You have to fill out a Form C. You have to do an audit on your financials in some cases, because you're basically going public. In the eyes of the SEC, you're now a public company when you go on a crowdfunding portal. Okay. And then you set the valuation. And you bring up a good point. I see a wide range of valuations, what my company is worth, when I see deals coming from the Title III world. In some cases, I think they had very good guidance on what their company was realistically worth. And in other cases, I think people got a bigger idea than they thought it was, and they come out with valuations that are not quite on target. Yeah. And I see those all the time when they come to me. They come to me when they want to go to the angels and the VCs after the Title III. It used to be you could raise up to $1 million. Now you can raise up to $5 million on the Title III. So we see a lot of parallel activity between crowdfunding and angel investing because we're at the same level there. The problem is that if you went and set the valuation on your own in a Title III Reg CF crowdfunding portal, you may have not put enough market reality into that. And then when you leave and go to the rest of the world, angels and VCs are the first stop, you'll quickly find out if you were market rate or if you were not. And so we see that quite a bit, that is a major issue, is how do you make sure the terms are going to be relevant to everybody, not just the Title III. Yeah. I'll be candid, crowdfunders primarily look at the product. Is it interesting? Do I think it's cool? Do I like it? And they don't look at valuations and metrics and those type of things, which angels and VCs normally look at in a business.
Yeah. So, yeah, and I guess, in my limited knowledge, I think with the angel and the VC, you get a lot more help. They're gonna, I guess I'll ask you, what is the typical goal of the angel or VC as far as the length of hold, and is it to take it public, or is it mainly just to increase the value and then sell it in the open market?
I'd say that for the angel and VC, the goal is to take a company, hold it for 5-7 years, and then sell it for 10x what you put into it is a rough cut there. And very few companies go public anymore. They stay private much longer. There's so many more funding options privately. You can actually sell the shares after 5, 6, 7 years on the secondary markets, and companies stay private so much longer. You really don't see many IPOs. You do some, especially in the life science case. And angels are the same thing. They want 3 to 5 times their money in 3 to 5 years was the mantra in the angel world itself. And so they're looking to make a good gain as well on it. Angels bring expertise. There's a lot of startups and founders that need more experience and knowledge about how to run and grow a business and about how to hire team members. Angels are very helpful with that. And then VCs are also helpful with that. Plus, they also can help you raise follow-on funding if you're continuing to grow up the curve and need more funding. They can be very helpful in that direction. The crowdfunding world, people go to them because they want the brand to get to a broader group of people. They want customers. They want people to support them, but they don't usually lean on crowdfunders for team or expertise like they do with angels and venture capital.
Yeah. So who is suited, to come to you we'll talk about the paperwork and kind of get ready for that in a minute, but just, the average guy out there, he's either he's probably developed a really cool product that's thinks has some potential, or has had a little bit of potential in a smaller market. And then, so they want to come to you to try to take this to a larger market. And then also, I assume, to get that expertise, that need to go from, a smaller, maybe 1 or 2, not necessarily 1 or 2, but sometimes it goes from the founder to, really a huge type environment, like a corporate environment.
Sure. So when they come to angels, angels are what we call go-to-market money. You're in the market and you're starting to grow and you need some funding to carry it forward. That's where angels come in. Once you have a little bit more traction and now you're growing in the market, that's when you find venture capital will come into it. So in our program, if you have revenue, come on in, let's talk about it. If you're pre-revenue, it may be a little bit too soon for the angels. And we get into this place where startups would come to me and say, well, in 2 months, we're going to the market. And I find that that's many investors are just very skeptical about that because they've invested in a deal before that was going to market in 2 months and it turned out to be 2 years. They really weren't in the market. So my coaching is to startups, get to the market as fast as you can. If you have to come up with a smaller product or a lower price product or a discounted product, sell something and get in the market. And then we get past that. Are you in the market? You want to be in the market. And then you can access angels and VCs much more readily.
So now, we've had an initial conversation. You kind of like, I'm in the market doing some stuff now. I'm like, hey, I'm ready to do this. What are some things how do I need to get my house in order to, to go to the angel or the VC? What are some specifics that we need to do there?
Well, the first step is make sure you're ready for fundraising, because when you take on outside investors, you have to have your documents in order. So make sure your accounting is up to speed. Make sure everything that you have put off is now done before you get to the investor. And we look for a pitch deck and what we call a data room. Data room are 10, 15 documents that most investors will look for, like income statement, balance sheet, 5-year forecast. Some of the basic things are already put together in one place. And then put together your plan. If you're raising money, how much are you raising? You need to have some vision of what that is and what you can accomplish with it. And then your pitch deck needs to show the story, how this is going to play out for the investor. My coaching is always, it's one team, one product, one fundraise, and one outcome. You don't want to play the multiple scenario game with the investors, and we see that quite a bit. Yes, we know you have lots of choices, but we really only can manage one. So let's start with one, later we'll pivot if we need to. But the idea is get your story together, get your documents together, and then start talking to your friends and contacts and colleagues, people that you know. It's always a great story to say, I went to my family and friends and they gave me some money, versus I went to my family and friends, they wouldn't give me money. How about you? I get that quite a bit. And I say, well, if your family and friends don't believe in you, I'm not sure I will either.
Right.
So demonstrate support from everybody you work with along the way. You put money in, your teams put money, everybody's supporting this, and you're just growing the support. Some people do go on to Kickstarter campaigns. They say, I went on Kickstarter, raised $20,000 in 3 days. That's great market validation. That's great product validation. And some people use crowdfunding to show traction and growth. And that's not a bad idea. So make sure you're using those things to demonstrate support, because that's what investors are looking for, is who else is in the deal, who else is validating this, and you want to show that. Customers are the best validation. Having a customer buy the product is the absolute best, because it now shows you got market validation and product validation. The product works and people will pay for it.
Yeah. So what is the difference between people, I guess, on the investor's interest, between I'm coming to you with this brand new product that I've just cooked up in my basement versus maybe I have streamlined or refined another product that's out there? Is there really any difference?
Well, it just goes to the market that you're going after. If you're in a brand new market, it may be okay to come up with your own product for it and so forth. If you're going to an existing market, then you'll probably be doing a product that other people have done, and both have pros and cons. If you're the first one in the market, well, then you're having to establish the market and educate everybody about what's going on, but you're the main player. So there's extra work, but there's an extra benefit. If you're going into an existing market, then you have to differentiate yourself and show how you're different from the others. Can't say there's no competition. There is competition. You just have to show how you're better than the competition. And in a very heavily marketed market like that, what you need to do is show a 10x improvement. If you're only 10% better, nobody's switching from what they're doing now to yours. But if you're 10x better, that's both cost and productivity, then you can actually get people to switch over because you have a much more compelling solution. So it really has to be a step above than, as opposed to just a slight change or advantage over something else.
Yeah. So how long does this process take? And I guess kind of what is that preparation? If I've just gone to market with something that, I'm finally getting this, a little bit of revenue coming in, but, do we need to think about this? I know we can't reach out until we kind of get to that point, like you were talking about, but we should really be thinking, if we feel like we've got a great idea, we should probably really be thinking about this a lot earlier than, waking up on Monday morning and saying, well, I think I probably need to really see if I can't get some capital in here by this afternoon. I mean, I know that's a little bit, kind of a little play on words there, but it does take a process, and it does take time, because I'm sure the investors, they want to do their due diligence too. They're going to probably do it on not only you, the product, but the market that you're trying to go into as well.
Right. Well, I always coach people, 6 months before you start your fundraise, you want to sit down and start planning it, get the documents ready, make sure the team's on board, get your lawyer in place, start circling up family and friends to say, I'm going to be raising funding, just to let you know that I'm looking for your support there. So you need to put some time into preparing for it, and you'll learn a lot along the way. What valuation we set is a big one. How much we raise is a big one. So there's questions you have to sort out, and it does take a little bit of time and input from people before you can really finalize that. Once you have that, you can go out and start to raise money from people and start to bring it in. My rule is, for every $1 million you're trying to raise, it will take you 1 calendar year to raise it. So those who want to raise $1 million at the seed level, my coaching is, let's start with 250. And let's go raise 250 first, because you're giving up ownership of the company and your valuation is not so great at the beginning. It gets better. That's the valuation, is what your company is worth before the money goes into it. And then the higher that valuation, then the less ownership you're giving away. So if you raise $1 million at the seed level, you're probably giving away too much equity. Start with 250. That's the minimum. You can go raise from an angel group or any angel investor. If you try to raise less than 250, they'll wonder if you have enough money to really accomplish what you say you're going to accomplish. 500 is a good number for a seed level raise as well. But raise that money, deploy it, get the result coming back. And as you demonstrate more products and revenue and team, your evaluation takes a stair step function up, and you can raise bigger amounts later on not such a bad number. And so that's the coaching, is start small, tranche it out and milestone it, and go stepwise up the curve there, because you often find that sometimes you just don't need to raise money. You just need to spend your time doing it, and you can save the dilution from that as well.
Okay. Yeah. So how complicated does that structure become as we, we start taking on or people start investing money? Are there pitfalls that we should watch out that, maybe not from the professionals as much as, Uncle Joe's loaning me some money, and then being careful about, how much of that company we give away, or structuring in a way that that they can be bought out very easily? Any things like that we should be watching for?
Sure. The valuation needs to go up on every fundraise. And one mistake people make is they want to give family and friends a better deal. So maybe my company's worth $5 million, but I give my family and friends a $10 million valuation. This becomes a problem later when you go to angels who are at the $5 million level, wondering, why would I pay 10? This is worth 5. And so you end up reducing the ownership that the family and friends got to bring in other investors. So you want to keep the big picture in mind. I have to stair step function this up from a family and friends to angels to VCs. And you have to have a certain amount of revenue at each level to get that. So the question I always ask is not, can I raise this round of money at that valuation, but if I do so, will I be able to raise the next round at the next valuation? So keep the bigger picture in mind as you put the valuations out there. One way to handle this is with convertible notes or safe notes. We don't set the valuation. We set a limit on the valuation, but not the valuation. And we'll figure that part out later when we get to investors that are putting money in for equity. At the very early stage, it can be hard to figure out what this thing is really worth and get agreement on it. So we can move that decision down the road a little bit. And there's a lot of investors that just want to be in the deal, and we'll figure out valuation later. So convertible notes and safe notes are often tools used at this level.
Okay. So what about giving away ownership, or not giving it away, but somebody is purchasing it? Are there, kind of rules that because a lot of people don't want to give up control. They don't want partners that are, too heavy handed. But the reality is, if people are going to invest money in your company, they're going to want to have a say. How do you, have a balancing act between, not giving away? Because a lot of times too, these companies are the younger ones that are growing. It's dynamic and there's a lot of excitement, and we don't want to tamp that down as well.
Right. Well, in the end, it's a negotiation. As you go through each round of major funding, it's about 25% of the ownership is going to go away. So you're up for some dilution as you go through this process. But the terms are usually a separate negotiation from the valuation. And as you go forward, you're going to need a bigger team, and you're going to need investors who can help you with the business. You'll be going into areas you'll need more support with. You'll need additional money. So you have to think along the lines that I will have to go through dilution. I will have to bring other people and treat them as part of the team as opposed to not part of the team. I have been at the end of exits many times where the founders own maybe 10, 15% of the company at that point and no more. So realize, the further up the curve you go, the less ownership you have, but then the value of the business is so much greater. So you have to keep both in mind, not just my ownership, but what is the value of the company, because you're getting a smaller slice of the pie, but the pie is much bigger as you go up the curve.
Yeah, and if you have like a real home run going, do you see that the founders do get to stay in and have, or still run the business and still have, somewhat autonomy and control? Or does at some point, when it gets to be to, a certain size or certain, I don't know how you would gauge it, but more, the professionals start stepping in and kind of moving the founder over?
Yeah, as the company gets bigger, you'll also find that as a founder, you're going to need many more skills, many more hours. And it really is a balancing act. What is the vision of the founder? Do you like working at the early stage? Do you want to work at the later stage? Do you want to learn new skills? Do you want to be on the road this much? And you have to start thinking through what it takes to really run a company at a much higher level. And I find many founders really have a passion for innovation and other things where they're happy to step out. Others want to stay in and so forth, and that's fine. You're going to have to start to take on other roles and bigger roles and so forth that you haven't before. So it really depends, I think, on what the founder's vision is about what they want to do. So, but you're right, as the company gets bigger, VCs are going to be expecting higher level skill sets, different activities to grow the business. And if you're signing up for it, that's great. If not, then we'll probably need to bring somebody else in. And certainly we need to expand the team itself for supporting that growth.
Yeah. Yeah. The other thing, I guess it's also good when we talk about getting our house in order. That's probably a good time to have professionals brought in. We need to probably get our lawyer that's going to be watching out for our interest, but we also probably need to have a CPA or somebody that is doing our books, not just, I guess once you get to this level, it's not going to be okay that I've got a scratch sheet here down with our revenues and expenditures from last year.
Well, that's a good point. One of the issues we get into is, companies when they first start off and they're very small and so forth. There are certain things you have to do when you run a business. You have to pay your payroll taxes. You have to pay your income taxes. And many startups, especially in Texas, are thinking, me pay taxes? Why would I have to do that? And the answer is, well, we all have to pay taxes if we're earning revenue and making income and so forth. And you want that part to be clean and done properly. So the books have to be clean to show, that we're actually complying with the laws and so forth. And that's one thing investors will look for, is that we're got this part taken care of. It may not be the most sophisticated system in the world, but if we're getting meaningful numbers, we can manage the business and we're compliant with the legal, then we're in good shape.
Yeah. So what do you help with on through Investor Connect? I know that it says that you're dedicated to the education of startup investors. So is that helping the people that are going to be the investors investing? You kind of help them navigate the pitfalls of being an early stage investor.
Sure. I talked to a lot of accredited investors who are from other industries like real estate, oil and gas, and other things. And they'd say, oh, I'd love to invest in a startup. I just don't know how. I don't know what this pre-money thing is people keep talking about. And so I actually started this with an event. It was a lunch and learn I did in Austin once a month, where I'd invite investors to come out. We have 50 investors, have sandwiches, and have investors talk about how you invest in startups, give some experience and examples and some case studies. Unfortunately, that model didn't really scale. It just was a physical thing. And, the camera in the back of the room doesn't really capture it. So I took a step back and said, well, how do I get this thing online? And so podcasting was at the fore at that point. This was in 2013. And so I said, well, let's just do podcast interviews with the investors and then post it. And then we're natively online and we can get it further. And it's to help investors learn how to invest. And the best way is to listen to other investors talk about what they look for and how they invest. And about half the audience are investors. The other half are startups. Startups are trying to figure out what investors are looking for. Investors are trying to figure out how are other people doing this, and found that was a great way to do education, was through the podcast program. One of the best things I ever listened to when I was becoming an angel investor was what was called the Frank Peters Show. Frank Peters was a Tech Coast angel out of Southern California that did over 450 interviews, and they were hour-long interviews and beautifully prepared. And he interviewed VCs, angels, and others about how they did diligence and how they screened deals and so forth. And I learned more from that than anything else, and thought, well, podcasting is a great medium for education. So I went ahead and formed the 501c3 and said, well, this is just going to be about education. And so make clear. So we aren't promoting things, that are off from that. We're really here just to learn. And that's how we came up with it.
Yeah, and I guess on the flip side of that, the accelerators, you've got one that the SKU incubation station that you're involved with, and then you'd previously been involved one with Dallas. Who are those designed for? When would I want to come? Is it like, do you need to have the product, service, or whatever before you come, or can you just come like, hey, I'm interested in starting something up. This will be a good place to learn.
Sure. So in Austin, I had an attorney named Sherry Wynn Ressler come to me saying she wanted to help the startup scene in Austin. And we looked around and all of the tech things were pretty well being done and didn't feel like we needed yet another one. But I noticed when I ran the CTAN group in Austin that half the investments were in consumer product goods. And I thought that's interesting. They all said they were tech investors, but yet they're really in CPG. And that was an area that was coming up that was new, millennials wanting their own brands and new innovations in food were really taken to the fore. And so I suggested, let's do consumer product goods. And we put that program together under the name Incubation Station. And we later renamed it to SKU for what they, the categorization of products on the shelf. And it really took off. Today, they've got 35 companies per semester going through the program. It's national in what it does. And we had some great returns and exits from the early days when we put it together. We built a great group of mentors that came in and gave the education for it. So if somebody has a product and they actually have a product, that was one rule we had, is you had to have sold it. Most of them had built it on the stove at home in the kitchen, and then they were selling it in the local farmers market. That counts, but you're out there with a product. And now in the program, we were helping rebrand, repackage it, get them on the shelf at Whole Foods and other groceries and so forth. Most of them were food and beverage products at the time. It's later grown to include health, wellness, and other aspects as well. So it's for people that have an initial product, but they really need some education in putting their plans together. Then the same one in Dallas. The NFC Accelerate was a near field communication. It was a great technology, came together and helped companies come and put their product together for it also and get it out to new applications and so forth. So accelerators are great, but it's best to show up with a product of some kind so you get real benefit. Otherwise, it's hard to get much traction with sales and marketing and so forth without that.
Okay. Yeah, and those are great because it's like you said, it's easy to go so far with your product. It's taking it to that next level is where all these things can really help the founders out.
Absolutely. There's a lot to learn in a business, and it's great to learn it from people that are in your industry and sector. In SKU, we were spending a lot of time making introductions to buyers and brokers for different distribution channels, explaining how the fees work and so forth, talking about fundraising. You had many people come in and say, well, I just want to raise once and be done with it. But in the CPG deal, you're raising every 24 months, whether you need it or not, because that's how you grow the business. You had to fund more inventory to go on more shelves and add new products to the line. So it's going to be part of everybody's job is to raise funding. So let's go ahead and get good at it.
Yeah. And I guess, what about location? If, in our state, of course, Austin has become such a hotbed for, it's kind of the Silicon Valley of Texas now, from what I understand, a lot of startups and things going on. But does proximity have anything to do if I'm, way out in West Texas somewhere? Am I going to need to probably relocate to a city center to get more traction, or with the virtual environment, can I really do a lot of this online as well?
So after COVID, I'd say the answer is you probably doesn't matter where you are at this point. You can be anywhere and go raise funding. First meetings are always on online calls like this one. And so it's a great way to get out and meet people. My coaching is you need to have a national perspective on your fundraise from day one. It's great to get money from your local community and family and friends and so forth, but very quickly you're going to be looking national with it. So where you're located is not quite as important. Some products would benefit from one location or another based on how close they are to the resources, how close they are to the customer. But from an investor point of view, it really is it doesn't matter anymore where you're located.
That's awesome. Well, Hall, I certainly appreciate you taking time out of your day to come and talk with us. Anything else that you want to leave the listeners with to talk about the angel or VC investing?
I say now's a great time to, if you haven't become an angel investor but want to, now's a great time to get out there. There's a lot of great deals. COVID has given us a whole new startup cycle that's beginning now, a whole new set of care abouts, and that's when startups really thrive. The stock market's at an all-time high. The interest rates are near zero, so there's plenty of funding going out for startups these days. So we see a tremendous rush. We hear about the big tech companies going under regulatory and breaking up at some level. So there's going to be even more opportunity coming from the spaces that leaves open to new startups. So I think we're in a startup mode, and we'll be, I think, for the next 5 years, kicking off this new cycle. So if you have a thought about it, now's the time. 25% of the people that were employed before COVID are talking about finding a new job afterwards. And oftentimes that means starting your own business. So if you have a business and you want to raise funding, I'll be glad to work with anybody. Just let me know, and glad to talk with you about how to raise funding. Our website, tencapital.group, has quite a bit of information as well, e-guides, calculators, etc., to help as well.
Okay, great. Before we get away, a couple of questions. First off, is there a tool or a habit, something that you do every day or use every day in your life, professional or personal, that really adds a lot of value?
I do a podcast every day called the Startup Funding Espresso. It's a 2-minute podcast that I put together. It's a great educational tool. It's very granular. You can either read it or listen to it, but it's a tool that teaches you something about startup funding and investing. And on Investor Connect site, we have you can listen to it there, but we also you can subscribe to it in an email where it shows up, where you can read or listen to it Monday through Friday. It's a 1 to 2 minute read, and it's something that you can learn about that really helps you with the startup funding world. Over time, it'll build your knowledge base in a nice way.
Okay, cool. So let's tell people, of course, who do you like to work with? How can you help them? How they can reach out and get a hold of you? And then also tell us where we can find the podcast at.
Sure. So we like to work with entrepreneurs who are in the market and growing their business. And we love to work with people that have a growth story. Things are moving forward. If you need help with, like, from an accelerator, whatever, it's best to go to accelerators. But if we're just doing well and we just need funding to go forward, that's who we look to work with. And the best way to reach us is through tencapital.group. And the podcast is on the investorconnect.org website. So we have 2 websites there, and the investorconnect.org is the podcast site itself.
Okay, great. Well, again, thanks so much for taking time out of your day. If you're on the investor side, if you're a founder and thinking about looking for some money, reach out to Hall, let him see what he can do for you. Again, that's going to do it for us on this episode. You can find us at www.thebusinessofbusinesspodcast.com. We're on all the major podcast platforms: iTunes, Stitcher, Google, Spotify. If we're not on one that you listen to, if you'll reach out, I'd be glad to add so you can listen easier. Also, we're on all the major social media platforms. Probably tend to hang out on Instagram a little bit more, so you can reach out to us there. A video of this interview will go to our YouTube channel when the episode goes live. So until next time, take care of yourself and take care of your business.
Thank you, Roy.